Hello and welcome back to the Retirement Resource, the one place committed to helping you navigate the often complex world of retirement planning. And I'm excited because we're going to start another masterclass, and we're going to do a series here with who I consider the master of reverse mortgages. This is my good friend, Don Graves. He spent over 20 years in the reverse mortgage industry, and he's an adjunct professor through the American College of Financial Services. And he's the guy I call when I run across people that have questions or need help accessing the equity in their house or understanding housing wealth. So I'm very excited and welcome Don Graves. How's it going, Don?
Thank you, Beau. I'm doing super great. Thanks for having me back.
Well, this series. What I'd love to do is let's give them good information. Let's hit them hard and hit them fast. And
okay.
Then we'll come up to another topic. I'd rather us get a bite, understand it, and then add another layer to it. So the first thing, we talk about reverse mortgages.
Mm-hmm.
Where did that even come from? Why did that even start?
Sure. Over 100 years ago in Europe, it started 1961 here in America. Here was a basic question. Mm-hmm. If we're living longer, we've not saved enough, how do we help people have a satisfying retirement? Well, one of the assets that most people had, retirees, was a home. So how do I use the home if I don't want to sell it and use it that way, or I don't want to take a loan and make monthly payments? Well, the thought was, what if I could use the home, access the capital without the burden of making a monthly payment? Would that help me sustain a long and satisfying retirement? So that's the genesis of it overseas, 1961 here, 1988, part of the federal government. It's designed to be a resource to help for retirement longevity.
Well, and I know there's been a lot of changes since it was even started here, right? Mm-hmm. So in that progression, let's talk maybe just to hit a little bit about some of the changes you've seen. I know we're hitting overviews, but who today is using this?
Sure. Everybody who's retired who has a home has an opportunity to look at it and ask the question, if I'm developing a retirement plan, whether with an advisor like yourself or on my own, does it make sense to use all of my available assets, my income, my investments, my insurances, and my housing wealth? So the spectrum of people who are using reverse mortgages go for those who maybe be on fixed income to those who have a couple $1 million in the bank and are thinking, well, I don't want to access that. I want to use my housing wealth because that's cheaper than using money out of my investment account. So it's a wide range of people that we're seeing these days that are using their home equity.
So there's multiple scenarios, multiple ways it can be used to solve multiple problems.
Absolutely.
Well, one of the things is we're talking to Don Graves, the authority on reverse mortgages. And he's the expert authority here for the Retirement Resource, our community, and our viewers and listeners. And we're talking about reverse mortgage basics. We realize before we dive into this, we need to spend this first clip or this first video just giving a foundation for people to build on. So we talked about what it was when it started, who's using it today, a lot of ways to use it. So as we dig into it, how does it even work? How are benefits determined? Or I mean, does the house have to be paid for or half paid off? I mean, how do we determine that?
Let me rewind the tape. A reverse mortgage is a federally insured loan. Some of the jumbo or private go up to homes for $9 million. So it's a reverse mortgage is a loan for those age 62 or over that allows them to convert a portion of their home's value and turn it into tax-free dollars without having to make a monthly payment, without coming off title of the home, without giving up ownership. The amount of money they get is based on three things: the value of their home. This is not a Jay-Z sign, it's a triangle. The value of the home, the age of the youngest borrower, and the interest rate. The loan gets repaid when the last surviving borrower permanently departs the house, moves, or deceases. At that time, think of a credit card.
Okay.
If you got a credit card and you never used it, how much would you owe? Well, you wouldn't owe anything.
Right.
But if you got a credit card, you used $100,000, you would owe $100,000 plus interest. So the amount of money that gets repaid on a reverse mortgage is whatever the borrower has used plus the accrued interest. And typically, the heirs will sell the home, pay that off, and 100% of the remaining equity goes to the borrower, the heirs or their estate. That's the basic premise of the reverse mortgage. And so that's how benefits are determined. Again, age of the youngest borrower. Only one person has to be age 62
Okay.
except in Texas, both have to be age 62. The other has to be 18.
Okay.
And value the home in the current interest rate. So today at this taping, a 65-year-old is looking at probably 50% of the appraised value of their home. So if they got a $400,000 home, a reverse mortgage is making a 65-year-old around $200,000. If you're 85, that number is going to be significantly more.
Got it. Okay. Excellent. Because the life expectancy shrunk.
That is correct.
Very good. Well, so you said something, and I know we may hit this later, but I don't want to completely skip this now. We're talking about taking retirement income, possibly, if that's the goal, or as a loan. Now, let's talk about that a minute. Taking income as a loan, that has an impact that changes some things from the way most people draw down retirement assets. So let's talk about that a little bit. The difference between maybe I'm using fully taxable 401k assets versus what are some of the benefits of actually taking a loan as an income stream in retirement?
Well, there are lots of ways you can structure this. I've got a plan for a longer retirement. People are living longer. They're highly indebted. They've not saved enough. So I need every possible tool in order to manage and to have retirement satisfaction. So I want to maximize my income. I want to maximize my investments. I want to look at my insurances. And people have already used housing wealth. When you're young, you use a 30-year mortgage because you didn't have the cash to go out and buy it.
Right.
When you're in your middle ages and you want to help get the kids through college or put an addition on, you didn't want to cannibalize your retirement assets, so you borrowed money, a home equity loan, and made payments back. So we've been using loans for a long time, housing wealth, so that we can have a better retirement. So when we look at what's the most appropriate type of resource when I'm in retirement, should I take a loan that I have to make a payment? If I have the opportunity to take a loan where I don't have to make a payment, now I can leverage these other resources, my income, my assets, my investments, excuse me. And because it's a revolving loan, it's bi-directional. I take last week. I don't know when this will air, but last week was a bad week for the stock market.
Right.
Someone started Monday with $1 million, had 880,000 at the end of the week. That's fine if you have time to recover, but what if you needed income during that period of time? You're going to suffer three losses. Market loss, the loss of opportunity if you have to take the money out, and loss of sleep, perhaps. If you had a different asset to say, man, if I didn't have to take that money out, I could give it time to grow. Well, what if you had housing wealth? What if you had a home equity line of credit that you could live off of? When the market recovered, you can pay that back if you wanted to. What does that do to the overall retirement picture? I tell you what it does. It sustains your portfolio significantly longer, even doubles the probability of success if you have a non-market correlated buffer asset like a reverse mortgage. So I don't often think of it as like a debt servicing. I think of it as an asset. Someone says your home is an investment. I said it's not. It's a non-performing asset. Right. You can't do anything with it until you liquidate it. Only way to liquidate it is sell it and move, or to take out a traditional loan and make payments. Here's a third way to unlock the equity in a way that I think is reasonable and responsible.
Very good. So there's multiple ways we can unlock this wealth.
Absolutely.
I think a lot of people just think of it as that income stream that comes in. But you've given some other scenarios that, hey, this helps solve a problem. Can we talk about a couple of those? Like maybe, can we eliminate a payment?
Oh, sure. And a fellow called me. He says, Don, I'm managing the wealth of a retired CEO of a multinational pharmaceutical company. He's got a $4.5 million home, and he's looking at a reverse mortgage. And I said, okay, tell me the story. He says, well, he put in an elevator last year, and he spent $200,000. And over time, he's now borrowed $2.1 million on that $4.5 million home. And the debt servicing, Beau, is $21,000 a month, principal and interest.
Okay.
And so that's $250,000 of cash flow. And even though he had $5 million, the client comfort was, I don't want all of my gains or all of this to go for debt servicing. Is there a type of reverse mortgage that can eliminate this $2.1 million that I create, $21,000 in cash flow, and I can do other planning with that or just enjoy my retirement? And there's a jumbo reverse mortgage that did that. So we see that, and it doesn't have to be the $4.5 million home. It could be someone in fella in Texas $400,000 and got a $180,000 mortgage, and his wife got sick. And she thought, well, I'll work as a real estate professional. I do that for a long time, but you couldn't. So all of a sudden, that $1,750 a month was a burden to them.
Right.
So anytime your listeners, your watchers, your viewers are saying, I've got a home, I'm sitting on my home, what can be done with it for my retirement? Well, there are 42 strategies. That book behind you, the one you have on your screen, outlines all the things that people maybe have never considered, ways to use housing wealth. As simple as eliminating the necessity to make a mortgage payment is one of them.
When one of the things, Don, my whole philosophy is, hey, if you have a good strategy, you'll have a successful retirement, as opposed to in a vacuum, this is the right, here's my product, let's make it fit you. Let's have the right strategy. One of the things I love about that potential with the loan is done right, we could actually reduce taxes we pay, right? Taxes owed on Social Security. And imagine that. Imagine if we, instead of paying 85% or 50% of our tax on Social Security, by us accessing income in another way, what does that add up to over 20, 30 years if we don't have that tax?
Oh,
it's a lot of ways to look at it.
It's unprecedented. I know you had a guest that really talks about managing your tax brackets.
Right.
So if you have a $400,000 home and you can convert that into a $200,000 reverse mortgage line of credit, just as an example, well, those dollars are going to come out tax-free. So if you're saying, wow, if I spend one more dollar, I'm going to go from a 14% tax bracket to 24 or 24 to whatever the number, or my Social Security is going to be taxed, or my magi are going to come sooner than I want them to come. I wish I had another resource to have some income, because I'm so limited and constrained, I'm not even enjoying retirement anymore. I'm squeezing the dollar so tight that the eagle is screaming. And so, and so now I would say to folks, I don't know if it's the right decision to make.
Right.
I believe it's the right conversation to have, to take a look at what a growing line of credit would look like for you. If you set up a reverse mortgage line of credit, and it's growing at 4.5%, 5% today, and that comes out tax-free, what is it that you can do, or work with someone like yourself, Beau, to structure that? That becomes really exciting.
And that's the exciting part to me, Don, is we need to model these things. We need to compare, here's scenario A versus B versus C, and see what gives me and my family the most use of my money, because there's no rules of thumb because Tom, my neighbor, or Johnny at work said this is what he did. That doesn't mean it's every scenario. What fascinates me and why I love this work is I'll sit in with 20 people from a workshop. 20 different puzzles, 20 different scenarios, 20 different ways we put it back together. So that to the viewer, that's just to say, this is another tool that we need to put in the mix and see, are there ways we can utilize this housing wealth to get a better result for me and my family? Sure.
And listen, we'll cover it in other segments, but most people just don't. Here's an example of a call today. A client, I asked them, the advisor said, Don, would you do a case study? And I'm always looking, is there a problem to solve? Is there a bridge, a gap to bridge? Is there risk to insure? And what's on your heart? Well, what was on this lady's heart is when my husband dies, his pension dies with him.
Right. Okay.
And so I said, so you need some pension replacement insurance. Is that what you're telling me? Well, is that going to come from your income? No, your investments, maybe your insurances that you have, or can we turn your home into pension replacement insurance, or just model what that looks like? She says, I'm also concerned about long-term care. My mom has Alzheimer's, and this thing runs in my family. I said, okay, you didn't buy that insurance here. It's going to be very expensive now. Let's talk about some ways to self-insure. How can we turn your home into a long-term care provisional plan? There's 7 different things we can do. And so as people begin to say, oh, I didn't know that. I didn't realize that I could do that. My mantra is always the same. I don't know if it's the right thing for you to do. I know it's the right conversation for you to have.
That's it. And I think that one of the biggest mistakes I see in this retirement planning process is people don't build their contingencies. It's like what happens when a spouse dies. There's not a
Hmm.
lot of mystery. Income drops by about a third and taxes actually go up. The trick is, what's our plan today for when that happens?
Right.
And if we can do that, and I love that idea. Okay, maybe this is one of the options we can explore with our housing wealth to replace that income, because it will happen. What tends to happen, unfortunately, is we just wait till it happens, then we act surprised and scared and have fewer options. So
Hmm.
for peace of mind, security, let's model these things. Let's think through these things. And I know, again, Don, I know we could talk all day, but as we're kind of setting up this basics of reverse mortgages, I
Hmm.
know there's one thing we need to cover before we transition out, and that's, there's 4 requirements that we need to know.
Absolutely.
Okay.
And when you get a reverse mortgage, there are 4 things that you have to know. These are absolute requirements. If you don't do these things, then there may be a triggering issue and you could lose the home. And that's very serious to say that. So let me give you these 4 very serious and somewhat spooky requirements. Number 1, you have to live in the house. At least one of you. You can kick your husband out, but
Right.
someone's got to stay in the house. Meaning you can't go to Florida and rent it out to cousin Tracy. You have
Yeah.
to live in the house. Number 2, you have to take care of it. You can't let a tree fall through it and not replace it. Number 3, you have to maintain homeowners insurance on your property. And number 4, you have to pay and keep enforce your property related taxes, or keep up with, so that's your homeowners association or your regular property and school taxes. You have to keep that in force. And so those 4 things: live in the property, take care of it, pay your taxes, and keep insurance in force. Probably most people who just read that said, well, Don, I'm already doing that.
That's
I
what I
said,
do.
absolutely.
Right.
And I said, but there's some people, you might be surprised, that don't pay their taxes.
Right.
And once you get a reverse mortgage, that's going to be your continued responsibility. So that's very, very important. And then we didn't talk about how you can take the money. Real simple. A lump sum, so you can't get it all in one year. You got to divide over 2 years. A
Okay.
line of credit, and then monthly payments. So those are a combination of those 3 basic ways to take the money.
Well, I've heard you say something. So let's go back to the 4 requirements.
Uh-huh.
As long as those aren't too scary for you, and like you said, we're doing that anyway, then okay, maybe it's something that's not as scary as it might sound or seem, or have some kind of bad reputation from fear tactics that.
Yeah.
So I like that. But as we go through it and we have the ways to take it out, I think something you said that's always stuck with me, Don, is that this is just a reverse mortgage. It's really just a mortgage.
Yeah.
It's a mortgage with some different features and functionality that might help us navigate some very specific situations.
Yeah. 4 words will save you at the barbecue. And you ever mention reverse mortgage and mixed company
Right.
at the family reunion barbecue? 3 people left. And then your uncle made a shank out of a plastic knife and fork and came after you. It could be dangerous to mention a reverse mortgage. Here are 4 words. 4 words that stop people in their tracks.
Okay.
And it's just a mortgage. It's just a mortgage.
Right.
I said, when you look at it under the hood, you lift up from the hood. It could be a truck. It could be it's just under the hood. It's the same thing. It's just a mortgage. It's a way to access equity in your home. Use it. If you want to make a payment, you can make a payment. You don't have to, but it's just a mortgage. And
Right.
someone says, well, when you die, when mama dies, we're going to treat this just like a mortgage.
Right.
If mama owed Chase City, Wells Fargo, Bank of America $100,000, and when she died, what's going to happen? The executor is going to sell the house, typically, pay back Bank of America, and whatever's left, they're going to divide it up. Whatever. That happens in a reverse mortgage. Folks, it's just a mortgage. It really is. And so let's take it out of spooky land. You know, that part of the theme park where you had a haunted house and mama said the last little girl went in there. She never came out. let's bring the reverse mortgage over where the Ferris wheels are and the teacups, and because it's not spooky, folks. It's a resource. Is Social Security spooky? No. Is Medicare spooky? No. Here's the 3rd government-supported retirement plan, the home equity conversion mortgage. It's the 3-legged stool of a government-sponsored retirement. It's not spooky. It's misunderstood. It's talked about, but it's anything but spooky.
Well, no, Don, thanks for this. I think we've got a good foundation started, and we're talking to Don Graves, author of the Retiree's Guide to Housing Wealth, resource to me, our team, our viewers, our listeners. And again, is this a tool I have access to that can accomplish a goal or solve a problem better than I could otherwise? And that's really, I think, the message. And some of this is just, let's take a little bit of the fear out of it, but let's dig deeper. So I think we did a good job here with some basics. Where will we go next time we see each other, Don?
Next time, if I told your viewers that they could convert a portion of their home's value into a reserve fund that had a tax-free minimum growth rate of around 4.5%, 5%, couldn't be frozen, canceled, or reduced, and was not dependent on their income, assets, or even their home's underlying value, would that be something they'd want to learn more about? That's what we're going to talk about next time.
I think we might have people tune into that. That sounds like a good headline to explore further. You've been listening to the Retirement Resource. I'm Beau Henderson here with our good friend, Reverse Mortgage Authority, and author, and just all-around fun guy here, Don Graves. And we're going to be coming back next time on this Masterclass series, diving into the next topic. See you next time.